All right, today we're going to pull back the curtain on a multi-trillion-dollar market that's usually, completely off limits to most of us. Private credit. We're going to break down exactly how these giant funds are generating double-digit returns in a world where pretty much everyone else is struggling to find any kind of decent yield.
Now just look at that for a second. The size of that gap is what's so wild. I mean, getting a 4% dividend from a stock is considered pretty good, right? So how on earth are these institutions pulling in 3 times that amount? What's the secret sauce? Well, here's the thing. It's not magic. It's a strategy. They've just decided to become the bank themselves.
So here's what we're going to cover. We'll start with the problem every single investor faces. Then we'll go inside these so-called shadow banks. We'll look at their playbook, figure out how they protect their money, and finally, we'll talk about the one major catch, the brutal truth you have to accept to even play in this game.
All right, so let's kick things off with a feeling that's probably pretty familiar to a lot of you. That frustration of trying to find decent, reliable income from your investments in the good old public markets. It is a real challenge. I mean, when you look at the usual suspects, the problem becomes really obvious, right? On one hand, you could chase after those high-yield dividend stocks. But let's be honest, the ones with the juiciest payouts are usually the most fragile. That high yield is basically the market screaming at you that a dividend cut is probably coming. Then on the other hand, you've got traditional bonds. Yeah, they're safer, in theory. But with yields around 4 or 5% after you factor in inflation and taxes, you're often barely treading water. This is the exact dilemma that forces big money to start looking elsewhere.
And that is what leads us into this whole other world of private credit. Now, this isn't a stock or a bond you can just go buy on Robinhood. This is a much less visible institutional-only market, where these funds lend money directly to companies, basically stepping into the shoes that banks used to fill.
So what even is private credit? At its heart, it's actually really simple. It's just non-bank lending. Ever since the 2008 financial crisis, new regulations made banks a lot more cautious about who they lend to. And that created this massive opening for these funds. They raise a ton of capital, and then they lend it out directly to companies, completely bypassing the traditional banking system. And by doing that, they get to capture the profits a bank would have normally made.
Okay, so what's really important to get here is that these high yields, they're not coming from some crazy, complex financial engineering. It all comes from a very straightforward and, frankly, powerful business model. Let's walk through the playbook.
Okay, so here's the play-by-play. First, a fund raises billions of dollars from huge investors like pension funds and endowments. Then they go out and hunt for these established, mid-sized companies that need cash, maybe to grow or buy another company, but they're kind of stuck in the middle, too small or too specialized to issue public bonds. That's when the fund steps in and acts as their personal bank, negotiating a loan directly. And finally, they just sit back and collect the interest payments, which are often way higher than public market rates because, well, these borrowers just don't have a lot of other options.
Now, I know what you might be thinking. Wait a minute, lending to smaller, mid-sized companies? That sounds pretty risky. And you'd be right, it can be. But these funds have a really powerful way to manage that risk. They make sure they are positioned at the very, very top of the food chain.
They do this with something called senior secured debt. And you really need to get this term because it's the whole key. Senior just means you are first in line to get your money back. And secured means the loan is actually backed by the company's real, tangible assets, its buildings, its equipment, its inventory, you name it. That collateral is their safety net.
So when we say secured, this is what we're talking about. It's not just some promise on a piece of paper. It's a hard, legal claim on the actual physical assets of that business. We're talking factories, warehouses, all the inventory sitting inside. If the borrower can't pay the loan back with cash, the lender has the right to come in, seize those assets, and sell them off to get their money back.
And this leads us to what's called the bankruptcy payout order, or the pecking order. Think of it like this. If a company goes belly up, there's a strict line for who gets paid. At the very front of that line, you have the senior secured creditors. That's our private credit funds. They get paid first from selling off all that collateral. Only after they've been paid back in full does anyone else see a dime. Next come the unsecured bondholders, then preferred shareholders, and dead last are the common stockholders who are lucky if they get to fight over whatever scraps are left over.
So far, this all sounds pretty fantastic, right? You get high yields, and you're the first one to get paid if things go south. But as we all know, there's no free lunch in finance. And that brings us to the brutal truth, the very high price you have to pay for access to these kinds of returns.
And here it is, the big catch. The brutal truth is illiquidity.
For these big institutions, their money is locked in for years. There's no stock market where you can just click a button and sell these loans. Now look, some of these funds get packaged into things called business development companies or BDCs, which you can trade like a stock. But even then, the stuff inside the fund, those loans, are still illiquid. And in a real crisis, if everyone panics and rushes for the exit at once, you might not be able to sell, or you'll have to take a massive discount to get out.
And this quote really just hits the nail on the head when it comes to the danger here. The very companies that these private credit funds are lending to, they're often loaded up with debt. So in a bad recession, their ability to make those huge interest payments gets squeezed hard. And if they default, the consequences are swift and they are severe, which just shows you how high the stakes are in this game for everybody involved. So at the end of the day, it all comes down to this one single critical trade-off. Private credit, yeah, it offers this incredible potential solution to the endless search for yield, but it demands a very steep price, your freedom to sell whenever you want. That extra return isn't free. It's what you get paid for agreeing to be locked inside. Which leaves us with the ultimate question. Is that reward really worth the risk of being trapped when the storm eventually hits?